In this lesson, we will now discuss how we deal with special revenue recognition as well as related presentation issues. So the special issues relate to our step number 4 in the 5-step process. The acceptable approach is to estimate standalone selling prices. Unlike the previous example, there may be times when the standalone prices aren't available. Thus, there are 3 allowable estimation methods per gap. First is the adjusted market assessment. Second is the expected cost plus a margin. And the third, which is by far the most popular, is residual approach, which let's review that one a bit further. Let's continue to review that data for an example of using the residual approach. Same data as before for Davis Inc. related to their gaming systems, except for one new wrinkle. They have not sold these annual subscriptions before, so the price for that is completely unknown. We do remember the total package price was $250, as discussed before. The standalone price of the gaming box is $240. Thus, the estimated subscription price would be the remainder of $10,000. In this example, the $10,000 would be deferred or unearned revenue to be recognized each month over the next year. Are you confused on these differences in revenue recognition under the past 2 examples? Let's move on to the whiteboard to review and discuss them further. Okay, so today we're going to talk about revenue allocation. We've looked at 2 examples in the last couple of slides. I thought we had to just take a little further look at this. In the first one, we had a situation where both prices were known. If you remember, the module itself was $240. The subscription ran $60 for a total combined price of $300. If you think about the breakdown, that means the module represented 80% of the value and the subscription represented 20% of the value. In our second example, we had one unknown price. So we had to use what's called the residual approach to figure out that revenue allocation. So if I look at the results over here on the far right, under the first methodology, we had earned revenue of $200 million and unearned for the subscription of the remaining 50. And those quite honestly represent the 80% we saw earlier and the 20% for the subscription. Under the second methodology, the residual approach, this became an earned revenue of $240 million, 40 million higher, and then we took that difference away and only gave $10 million, the residual, to the unearned revenue. So you can see these 2 methods, whether you know both prices versus just knowing one, give you very different results, because in this example, the earned revenue would be much higher under the second example and the residual, and we'd actually have a lower unearned revenue, which would get spread out over the next 12 months when that subscription runs. So as you can see, these 2 methods give you very different results on revenue allocation. Hopefully that revenue allocation example helped bring some clarity to this topic of step number 4, or more importantly, how to allocate that transaction price to multiple POs. Next, let's discuss some of the special issues related to step number 5 of revenue recognition. Some of the common items have miscellaneous timing issues related to recognition. Licenses, franchises, consignments, which relates to inventory, as well as gift cards, which we talked about in the early part of this course as well. Our first item relates to step number 5 special issues. First of all, we have licenses. Here we typically recognize the revenue at the start of the license period if it does not impact the property, such as iTunes music downloads that we all do. Or we recognize the revenue over a period of time of access if the seller's activity affects the benefit to the customer. Examples might be NFL trademarks or the NBA Adidas license that we see within pro basketball. Our second item related to step 5 issues is franchises, such as Subway restaurants. Usually this includes a license as well as various goods and services that must be utilized in the franchise. Each aspect of these franchises must be reviewed carefully to determine if they qualify as separate performance obligations. Our third item related to the step 5 issues are consignments. Here the revenue recognition is postponed until the actual sale to the third party. This is an example we're going to discuss a lot further when we get into inventory issues later in this course. Our last item related to step 5 special issues are gift cards. And these is where we recognize these as deferred or unearned income, which we discussed previously in this course. Here the revenue is recorded only when the gift card is redeemed, which is by far our preference, or where the likelihood of redemption is very remote, which is a much more involved and quite honestly detailed calculation we'd like to avoid. Let's now discuss the various financial statement presentation disclosure issues for revenue recognitions. In regards to the income statement, we'd have the following items related to revenue. First of all, bad debt expense, which we're going to cover this a lot later when we get into the course related to receivables. Next, we have interest revenue and expense, which relates to long-term contract financing. And next, let's discuss disclosure notes. We've talked about disclosure throughout this course. You're talking about one of the largest items on your financial statement, so you've got to really disclose the outstanding performance obligations as well as all the related terms. Also, you should talk about the nature, the amount, the timing, and uncertainty of any revenue and related cash flows. And lastly, in regards to the balance sheet, we would have the following items related to revenue. Contract liabilities, such as deferred or unearned revenue. Receivables, the POs that are satisfied before the payment occurs, which is very typical, we'd book a receivable for that case. And lastly, the contractual assets. These are your long-term construction contracts, which we're going to cover actually in more detail in next week's lesson.